Okay, perfect. I think we have members who have started to join. So let's get started. Yeah, perfect. So thanks guys for joining. I know this is a bit late in the day, but thank you guys for joining on this financial literacy webinar. So as you guys know, like finance is something that is very important for us, but unfortunately, it is not really taught to us in a formal way during our educational days as we grow up. But finance is something that we all should actually be learning because that is something that sets the stepping stone for us to achieve the financial goals. So, in order to help each one of you on how to achieve your financial goals, we have partnered with Access Mutual Fund, and we have an expert, Niranjan, with us from Access Mutual Fund. He has over 2 decades of experience in the finance industry, not just practicing finance, but also teaching finance to individuals like you and me. So today, I'm honored to have Niranjan with us, and he will be basically walking us and educating us on how investment should be looked at, how you should go about your investing journey, why is it important, and towards the end we will basically be keeping around 10 to 15 minutes for any Q&A. So each one of you is going to be in their investing journey or different stages of the investment journey. So you can ask what questions you have about either if you want to start investing or if you want to sort of optimize your current investments, you have the chance to get all of your questions answered. So I'll hand it over to Niranjan. And perfect, Niranjan, the stage is yours. Yeah. I think Niranjan, you're on mute. Yeah.
Everyone for attending the session and a very good evening to everyone. So we will start off the session by trying to understand why do we need to invest and what is the importance of investing, right? So just give me 1 minute. Yeah. So basically we will try to understand why should one invest. Basically is that, see, we all have dreams, we all have goals that we need to fulfill, right? We all have a lot of dreams. So how do I fulfill these financial dreams? Like, for example, I want to buy a house, I want to buy a car, I want to send my children for better education, I want to plan for my marriage or my children's marriage, or I want to go for a long vacation, I want to plan for my retirement, right? Everything needs money, right? For today, the situation is that everything can be financed with loans, right? I need a car, I get a auto loan. I want to buy a house, I take a housing loan. I want to go for a foreign tour, I take a personal loan. I want to get married, I get a personal loan. But the biggest problem with taking loans is that there is this constant fear in our mind. Oh, how will I be able to repay? The burden of EMIs crush all of us, right? So obviously there are certain things where we want to do, but we out of fear of incurring too much debt, you don't do, right? So how can I plan my investments, plan my money in such a way that I'm able to do most of my dreams, fulfill most of my dreams without becoming a financial burden on myself by taking loans, right? So that is why it is very important to plan our finances, right? It's very, very important to plan our finances so that we are able to live a life the way we want, right? Without having the stress or too much stress of taking loans on our head and living our lives. That is it, right? Basically, the biggest question we always ask is, but how do I achieve these goals, right? We have to take a simple example. Like, I give always an example that I am 45 and I did my education, right, from first standard to MBA. I did BCom. And this was around 20 years ago. I graduated in 2004. It's 20 years ago to be precise. I completed my entire first standard till my graduation, MBA, PGDBM, in less than 2 lakh rupees, right? First to 10th standard was very subsidized. School fees was 5 rupees, 6 rupees, 7 rupees. Graduation was around 1,000 rupees. That time, where I was doing MBA was around 1 lakh rupees per year, right? 1 lakh rupees for 2 years. So my entire education, right from my first standard to my MBA, that is for 17 years of education, the fees, total fees I would have paid was just around 2 lakh rupees. Today, for my daughter's fourth standard education, I'm paying 2.5 lakh fees. So what I invested, my parents invested in me for 17 years, I'm investing in my daughter in 1 year, right? And going ahead, also, I'm going to continue doing that. So the question is arising is how am I going to achieve those goals? How can I ensure that I give my child the best education? How can I ensure I give a child the dream wedding she wants? And along with that, how do I ensure that I'm able to live a very comfortable life, right? So now the question is, answer simple, that I invest my money, I save my money, right? So if I have to look today at the approximate returns on all my investments, today my FD will give me around 6 to 7. PPF has been 7.1% for almost now years or 10 years since the time I remember. Equities have given really good returns in the last 25, 30 years. Real estate, gold have given okay returns. Equities and debt, equity mutual funds have given good returns. Debt has given okay. Right? So these are our asset classes which we invest. We all love FDs. We all love PPF. We all love real estate, right? And gold. But how many of us look at equities as an alternative, right? Or debt as an alternative where I can grow my wealth, right? For us, the problem is I want safety, right? That is what we are used to. We are so used to that safety aspect of investing that we don't take any risk with our investments, or we're very hesitant to take risk with our investments. But unfortunately, that is perhaps the biggest risk I am taking, is that I am not taking any risk with my investments. Now, why is that a risk? The answer is very simple. Today, what is my rate of inflation, right? The government says it is 5.5%, but we know reality, right? Take a simple example. 3 months ago, how much was tomatoes costing per kilo? 25, 30 rupees a kilo. Today, that same tomato cost me 60, 70 rupees a kilo. Onions, few months ago, were costing hardly 10, 25, 30 rupees a kilo. Today, onions are 120, 130 rupees a kilo. 10 years ago, petrol was costing 10 rupees a liter, around 30 rupees a liter. Today, petrol costs me 100 plus rupees a liter. Very simple. My expenses are going up.
I think
Right,
Niranjan,
and they will
your
never come
voice is
down.
breaking a bit. Sorry to interject. Actually, Niranjan, I think your voice is breaking a bit.
1 second.
Yeah, sure.
Okay, I'm sorry. What I'll do is, I think there's some internet, so I'll just disconnect my video if it's okay.
Sure. Yeah.
Yeah. So now is it clear?
Yeah, better. Yeah.
Yeah. So if you look at what is happening is my expenses are rising quite fast, right? Today, if you're a working person, there's a very good chance that your incomes might rise in line with inflation, right? Suppose your expenses are rising by 6, 7% per month, per year. Your salaries might rise by 6, 7% a year. Maybe if you jump jobs, you get a 30, 40% hike. So to a certain extent, when you're working, your salaries or your jumps in jobs will cover up for inflation. So you won't feel the pinch so much. But the biggest pinch you will feel is once you stop earning, right? If you're a salaried class person like me, when you turn 60 or 58, you'll stop earning, right? Then what will you do? Do you think that money is going to be enough for living your life, right? So if you look at this, one of the best ways to earn, to create wealth is, how am I going to achieve an asset class or invest in an asset class which gives me significantly higher than inflation? And that is what wealth creation is. Right? Wealth creation means what? That my money is growing faster than that of inflation. And if you look today, one of the few asset classes which provides you that is higher than inflation returns, significantly higher than inflation returns, is equities. Right? So then you will tell, why can't you do direct equity investments? Why do I do mutual funds? Right? We know equities as an asset class is perhaps quite risky, right? Returns have been great. In the last 30, 40 years, Sensex has grown from almost 16% per annum, which is what we need, right? This is what we need. I need better than inflation creation. But the biggest problem of investing in equities is that which company do I invest? Or even if I have the knowledge, do I have the time? Because there is a good chance you might have the money, you might have the time, you might not have knowledge, or you might have the money and knowledge. For example, you are working in an organization. You know a lot of things about the company, your company is listed. You want to invest in that company, right? But then when will you get the time? Because your job means from 9 to 5, 5:30, sit in the office, do your work. Your job is not to sit in front of the trading terminal, buy and sell, right? So your job is basically, I want to work so that I'm able to create an income for myself. So how do I ensure that I, as an individual, am able to make my money work as hard as me? Right? That is the aim. How am I able to ensure that my money creates wealth for me? And this is where mutual funds come into play, right? Mutual funds is basically a, I have to put it, an outsourcing pool where you as an individual are outsourcing your investment needs to a third party expert, right? You have your money, you give it to a fund manager who invests it, generates the returns and passes it back to you. That is what basically a mutual fund is. Mutual fund, instead of you directly investing in stocks and bonds, identifying, buying, selling, you leave it to the fund manager. They are the experts, they will do it. Right? That is what mutual funds basically are. So this will help you relieve one stress. Okay, how do I grow my wealth? Right? So now question asks, what type of mutual funds are there? Because the moment I talk mutual funds, will think, oh, only equity is there and equity is very risky. Should I put my money in it? The answer is there are different type of mutual funds. I've got equity funds, I've got debt funds, and I've got hybrid funds, right? So equity funds are basically funds which invest in equity shares. Debt mutual funds are funds which invest in corporate bonds, then your government securities and those kind of investments. And my hybrid funds are funds which are invest in a mix of equity and debt. Right? All the three are important for an investor. We will see later how it is important. Question asks is what is equity, right? What are the different type of equity mutual funds? So basically, if I have to talk about equity, if I have to talk about mutual funds, equities, we have got close to 10 different categories, but we will focus on a few, right? Basically, if you have to look at mutual funds, they are basically classified as market cap based, focused fund, ELSS or tax saving fund, thematic funds, and value funds, right? In market cap base, we've got large cap, mid cap, small cap, and other categories. So let us try to understand what these funds are, right? So basically, if I have to look at large cap companies, right? Large cap companies basically represent the top 100 companies by market cap. So if I have to give an example of cricket, today, if suppose I have to ask you all, who are the best batsmen in India or who are the best cricketers in India? Right? The answer will automatically come Rohit Sharma, Virat Kohli, Jasprit Bumrah, MS Dhoni, or Shami. Why are they the best cricketers? Right? Because they are the people who have been playing cricket for a lot of time 8, 10, 15, 20 years. They have got the experience, they have got that confidence. We as people have got confidence, right? Whether Rohit Sharma or Virat Kohli is batting, we cannot lose. Or when a Bumrah or Shami is bowling, they will definitely get all the wickets, right? That confidence comes from there. Because these are the people who are the experts. They have played cricket. You ask them to play cricket in India, England, West Indies, anywhere they can play, right? They are the Mr. Dependables of cricket. Same way, my large cap companies. Large cap companies are my industry leaders. They, to a certain extent, we call it dependable stocks, very stable, steady stocks, right? They provide me stable returns. They won't give me very, very high returns, but they provide me stable returns, right? That is what large caps are. They are the stability. They provide the stability to the portfolio, right? They are basically the top 100 companies in terms of market capitalization. highly reputed companies with an excellent track record. And to give an example, TCS, Infosys, Axis Bank, SBI, Larsen and Toubro, Hindustan Lever, Maruti, Hero Honda, right? ITC. These are companies, the moment you say, oh, these are the best companies of the country, right? So that is what they are. So these are the large cap funds. They invest in my market leaders. They have got the potential to generate wealth over a long period of time, right? This is what it is. Then I come to mid caps. So mid caps are someone who desire to be the large caps, right? So today, if you see, I think today there's a T20 match going on, India Sri Lanka. And if I have to talk about a T20, it's like the mid cap team, right? They have been playing cricket for around 5-6 years. They are as they are good, but they will not be counted in the league of a Virat Kohli or a Rohit Sharma, right? They are still proving themselves to be, yes, I am the next generation. I am the next emerging leaders. That is what my mid caps are, right? Mid caps, if I have to tell, are the companies that are ranked in the 101st to 250th in terms of market cap, right? They are the industry followers. They are the second level leaders, right? Say, for example, I have to give an example in banking, say a Federal Bank or a IDFC Bank. They are the emerging banks, right? Or suppose I have to give, say, in an FMCG. In FMCG, I would say a Marico or a Dabur, that type of companies, right? They are the companies who want to grow to become the next big Hindustan Lever or the next big SBI. They have the potential to become the next big Lever or the next big SBI. But the risk is, we all know, like in the cricket team, only 11 people can play. So who are these 11? We don't know. Can I bet on any of them to become the next 11? Yes. But the risk is, if I make a wrong bet, I might lose money. But if I make a good bet or the good investment, I stand to get very high returns, right? And finally, we come to small caps. Small caps are like my people who have the very exciting players, right? For example, if you see over here, the Rinku Sharma or those kind of people, right? They have the potential to become the next great players. But if I have to give an example, actual example, say if you go back around 25 years, 1989, when Sachin Tendulkar debuted for India, right? That was, I think, the biggest turning point for Indian cricket, when Sachin Tendulkar debuted for India. So if you remember at that time, along with Sachin Tendulkar, another batsman from Mumbai also debuted, Mr. Vinod Kambli, right? So imagine these two people. They are your investment options. And say you had put 1,000 rupees in Sachin Tendulkar, 1,000 rupees in Vinod Kambli, right? By the time it was 2003, Vinod Kambli had actually proven himself to be a much, much better cricketer than Sachin Tendulkar, right? In terms of runs and all. He already had 3 double hundreds. He had scored very well. Whereas Sachin did not have any double hundred to his team. So today, but look what has happened. Today, the Sachin Tendulkar, if he was a stock, he would have given perhaps the best returns would have ever dreamt of, right? And Vinod Kambli would have get you losses. That is what the small caps are. Small caps are basically identifying the Sachin Tendulkars when they come team. That is what small cap stocks are. Am I able to identify the right stock which over a period of 20-30 years will help me to create supernormal wealth? But the risk is, instead of identifying a Sachin, investing in a Sachin, if I invested in the Vinod Kambli, I could lose all your money. That is what small caps are. Very high risk, but the right investments will tend to generate the best possible returns, right? That is what small caps are. So these are my market cap based one, large cap, mid cap, small caps. Then I've got a combination of both large and mid, multi caps, flexi caps, right? So what is a multi cap? Difference between multi and flexi, I'll just explain. In a multi cap fund, the fund manager has to compulsory keep 25% in large, mid, and small. And the balance 25 they can do wherever they want. In a flexi cap fund, the fund manager can decide, okay, how much I want to be in large, how much I want to be in mid, how much I want to be in small. There is no restriction. So this is the basic difference between a multi-cap and a flexi. Then the other funds, right, are my focused funds. So if I look at my other normal diversified equity funds, right, which we talked about, they will have around 60, 70 stocks in their portfolio. But a focused fund can invest maximum only in 30 stocks. Sometimes I personally jokingly refer it to as a common man's PMS, portfolio management services, right? Because this fund runs a very concentrated portfolio. Then I've got an ELSS scheme. This is perhaps one of the few equity funds which have got a compulsory lock-in of 3 years because it has to invest, it gets an ATC benefit. Then I've got value or contra fund, and then I've got a sectoral or thematic fund. Right? So these are a different type of equity funds that I can invest in. So that a moot question people ask, how do I invest in mutual funds? I've got money. Do I put all my money in one shot or do I put my money across a period of time? Because the biggest fear as an investor, what I have, oh, what if I invest my money, the market corrects and I sit at a loss, right? So that's why we say SIP route or a systematic investment plan route is a much better alternative to invest your money, where you invest your money over a period of time, right? We say, right, drops of water build an ocean. That is what SIP is, where I keep putting every month a fixed amount of money, and so that over a period of time, I'm able to create long-term wealth. Right? What are the benefits of, I can start an SIP as low as 500 rupees. So you cannot commit, say, sir, I don't have money, or ma'am, I don't have money. I'm sure all of us can definitely ensure that we are able to sacrifice 500 rupees a month and start our investing, right? And SIP basically tells me every month I'm going to invest a fixed amount of money. So it imbibes that financial discipline. I know every month this much money is going to go from my account to create wealth. So I need to keep that money aside. Rupee cost averaging and the power of compounding. I think these two are perhaps the biggest pluses of SIPs, right? I give you my own personal example, right? I have been investing I'll give you an example of a product called an NPS from the last 14 years. The first investment I made was in February 2000 and I think 13. So 11. Right? That first investment today has almost grown up by 7 times. But I had to hold it for 14 years. That is the power of investing. Right? That's why I say, when do we start? Answer is very simple. The earlier, the better. And look at a simple example, Mr. Early Starter, Mr. Late Mover. Mr. Early Starter invested 30 lakhs, 18 lakhs over a period of 30 years. And Mr. Late Mover invested 12 lakhs over 20 years. See the initial investment, the difference is only 6 lakhs. But look at the end corpus. The end corpus difference is almost 1.5 crore rupees, 1.3 crore rupees, right? So that's why we say the earlier you start, the more you can accumulate, the more you make wealth, right? So now the question people ask, but sir, I don't have too much money. How am I going to create wealth? Answer is very simple. Normal SIP helps us to create wealth. But there is this concept known as an SIP top-up. So what do we mean by SIP top-up? SIP top-up basically tells us that today I'm committing, say, 1,000 rupees a month. But I'm also committing that every year my investments will automatically increase, right? So today 1,000, okay, today I might start with a lower amount of money, but then I'm committing that every year as my income goes up, my investments will automatically increase. So what happens? I'm committing to myself that I'm going to increase my investments every year so that in the long run, I'm able to create more wealth, right? Sorry. So now people ask, sir, what kind of mutual fund do I want to invest in? How do I decide which is the right mutual fund investment for me? Here, the answer is very simple. There are 3 parameters based on which you choose an investment. The thumb rule says age minus 100 should be your equity exposure, right? So say I am 40 today. So I'm 45. So it should be 100 minus 45. I should keep only 55% in equity. You may be 25, so you'll say 75% in equity. Please understand this is only a thumb rule. It is not a fixed rule. So then how do I decide how much equity I need, how much debt I need? Follow these three simple principles. Invest based upon your investment horizon, liquidity requirements, and risk appetite. So what do we mean by investment horizon? So most of us, our biggest fear is what? That, oh, sir or ma'am, if I invest my money today, the market falls, then what? Right? How do I overcome this fear? The simple thing, follow the simple thumb rule. If your investment horizon is below 3 years, do not put your money in equities. If your investment horizon is below 3 years, do not put your money in equities. Put your money in debt, put your money in a hybrid fund. Why? Because less than 3-year investment horizon, there is a very good chance that the markets might correct or give you negative returns or very low returns for 2 to 3 years. That is equity markets in its nature. But when does the power of wealth, when does the power of compounding come? Wealth creation happens if you stay invested for 5, 7, 10, 15, 20 years, right? So simple. When my investment 10, 3 years, look at debt, look at hybrid. When do I look at equity? Look at equity only if my investment horizon is more than 3 years. And how do I decide upon how much time is, what is my time horizon? Answer is simple. Invest as per your financial goals, right? Now, what do we mean by financial goals? Say today I'm in the month of July. I know, I'd say in the month of May, you got a bonus, right? So you have a wish that I want to buy iPhone 15. Say you got a bonus of 2 lakh rupees and you know an iPhone 15, now iPhone 16 comes out. Say I want to buy an iPhone 16 Pro 256 GB. Based on the historical pricing, I know that the iPhone 16 256 GB might cost me around 1.5 lakh rupees. And it is going to come out during Diwali. I already have got 1.5 lakh rupees as bonus, right? So what will I do with this money? Keep it in a safe investment. Why? Because I know 3 months down the line, the iPhone 16 is going to come out and I want to buy the iPhone 16 256 GB Pro Max, which costs me 1.5 lakh rupees, right? I cannot take any risk with this money. I need to keep it safe. Or say on the other hand, suppose let me say, I'm thinking I've got to say an Alto today, right? This Alto is around 3 years old. And I know that maybe after 2, 3 years, I'm planning to get married. I'm going to increase my family size. I will need a bigger car. And I want to upgrade myself from an Alto to an SUV after 4 years, right? So say after 4 years, you're planning, okay, I'm going to buy an SUV. The SUV cost me around 12 lakh rupees. So what would be, how would you calculate? Okay, today after 4 years, suppose I sell this Alto, I will get a 2 lakh rupees on sale. I will put that 2 lakh rupees as down payment and take a loan for 10 lakhs. That's what we normally do, right? But what is the problem with it is the moment you take a car, you get the stress on the EMI. So how do I reduce the stress? Very simple. I know that after 5 years, I'm going to need 10 lakh rupees, right? So what do? I have to plan, okay, after 5 years, I need 10 lakh rupees. So every year I need to save 2 lakh rupees. So 2 lakh rupees every year is around, say, 115,000 rupees a month, right? So I start an SIP of 15,000 rupees a month every month, or say 12,000 rupees a month every month, 12 to 15,000 a month for the next 5 years, try accumulating the 10 lakhs, sell my car for 2 lakhs, take 12 lakhs, buy the car without a loan. Doesn't that sound more appealing rather than taking a loan for 10 lakhs and every time worrying, oh, my EMI, my EMI, my EMI? So very simple, right? I know I want to achieve a certain financial goal down the line, right? Say my target is when I retire after the age of 60, after 20 years, I need a corpus of 5 crores. After 15 years, my daughter is going to get married. I'll need a corpus of 50 lakhs. After 13 years, my daughter is going to do her higher education. I need a corpus of 25 lakhs. How do I plan for that? That is where my investments have to match my horizon, right? So the answer is very simple. Invest based on one's time goal, investment and goals and time horizon. As I said, if my investment horizon is less than 3 years, don't look at equities at all. Invest in debt, invest in hybrid funds. If my investment horizon is between 3 to 5 years, I can look at debt, I can look at hybrid, I can look at conservative, large caps, or those kind of products. When do I look at mid caps, small caps, multi caps, flexi caps, or very aggressive equities? I look at that only if my investment horizon is more than 5 years, right? If I follow the simple thumb rule, less than 3 years, debt and hybrid, more than 3 years, 90% of my stress of investing goes away. What stress? Oh, what if the market falls? I lose my money. Nothing to fear as of now, because 99% of the times over a 3 year horizon, we have seen that the Indian equity markets tend to deliver pretty decent returns. What will happen in the next 6 months, 1 year? I don't know. Will the markets correct by 30-40%? It has corrected. And to give you a simple example, in 2008, 1 year returns on the market was minus 55%. In April 2020, 1 month returns on the market was minus 30%. Every year, the market has seen a correction of 15%. In spite of that, over the last 30 years, the market has given me 15% CAGR returns, right? So how do I overcome this fear of investing? Is very simple. Invest as per my investment horizon. And how will I determine my investment horizon? Depending upon my financial goals. If my financial goals are less than 3 years, look at equity debt, look at hybrid. If my investment horizon is more than 3 years, only then look at equities. If you follow this mantra, again, I'm repeating, 99% of our stress in investing disappears. And secondly, also decide your risk profile, right? See, it is very, very important for us to understand what is our risk-taking capacity. When I'm talking about risk-taking capacity in investing, it basically tells me that how much I am willing to take a hit on my investment or a loss on my investment, so that later on I can get good returns. Right? So basically, risk profiling tells me that as an investor, how much losses, temporary losses, I am willing to see in my portfolio, so that in the medium to long term, I'm able to get good returns. So please ensure that you get your risk profiling done, and based upon that, you decide how much equity, debt, or gold you need to keep in, right? So basically, a conservative investor, we would prefer to give him more on the safety, less aggressive, and an aggressive investor, obviously, the more equities, less debt, right? But please understand one more thing. My decision to decide in equity, debt, and gold, right? This is what you call as asset allocation, will predominantly be driven by my financial needs, financial goals, right? Suppose, let me take an example. Say you're a very aggressive investor. Today you're sitting on 80% equities, 20% debt, right? But then you decide that I want to buy a house. Say your portfolio is worth 1 crore rupees, or 80 lakhs in equity, 20 lakhs in debt. Suppose now you have identified a house you want to buy, and for that, buying a house costs you 2 crores. And for that 2 crores, you need a 50 lakh down payment, right? You have to make a 50 lakh down payment. Although you are aggressive in nature, but because you have to make the down payment in the next, say, 1 month, obviously today I have to keep a 50-50 equity debt profile, because 50 lakhs I have to pay in the next 1 month, right? So here again, risk profiling will tell you what kind of asset allocation you do, but your investment horizon will determine your actual asset allocation. If you don't need the money, obviously you can take more risk, but if you need the money immediately, you have to take less risk, right? So this is the basic thing. So normally we say for a conservative investors, take more conservative funds. For an aggressive investors, you can look at very aggressive funds, right? So this is how, as an investor, if you're able to follow these 2-3 points, right? Again, let me repeat it. First, invest based upon your investment horizon. Less than 3 years, avoid debt, avoid equities, keep debt hybrid. Look at equity only if it's more than 3 years. Second, invest as per your investment horizon, right? Plan your goals, identify what are your financial goals you need, and then invest. Many a times people will say, but sir, I don't have anything in mind. I want to invest just for the sake of investing, right? That also we want to do. But please understand, there is going to be some unknown need for you. So if that is the situation where you want to invest just for the sake of investing, then I would suggest always keep a part of your money in debt. Why? Because we don't know when the opportunity comes or when an emergency arises that you will need the money, right? Always ensure that you keep some amount of money in a safety so that whenever the need arises or whenever the opportunity arises, you can shift your money from equity to debt. And third, get your risk profiling done. Understand what kind of an investor you are, whether you're a conservative investor, whether you're an aggressive investor, and then invest based upon your investment horizon. If you follow these 3 steps, then there is a good chance that in the short run, even if the market's correct, you will not be scared. You will not be fearful because you've already done your asset allocation. In fact, it will be an opportunity to add more, right? So if you want peace of mind, follow these 3 steps in investing. First, create a emergency corpus, which is normally equivalent, we say, to 3 to 6 months of your income. Second, create a strong, stable base in debt or hybrid. Then invest as per your investment horizon so that all the 3 parts are done. To follow this, there is a good chance that your entire investing experience would be wonderful and you can create wealth in the long term. Yeah. So I think with this, we more or less completed this session. If you have any questions or queries, feel free to ask.
Perfect. Thanks, Niranjan. Thanks for the session. Yeah. So there were a couple of questions that had come in from a couple of investors, but I think one of the questions you have already sort of answered. So before we go into the Q&A, just wanted to give a quick recap, like about our product also. Like as Niranjan mentioned, like there is a portfolio that you should be building when looking at mutual funds like debt, hybrid, and equity mutual funds. So basically, we have an app called a Simplifin, and where you can actually invest across all these different categories and also access mutual funds, which are also available. So please feel free to take a look at the Simplifin investment app. And now moving on to the Q&A. One question was that how do I diversify if even if I don't have a particular goal? So it's like I am like 25, 30 year old and I just want to invest my money because I don't want to keep it in my savings bank account. So what should I do with that?
So if you don't have any financial goals, maybe yes, because you're a 25-year-old, you might not have any financial goals. But we always have some aspirations, right? As I said, you're 25-year-old, you're earning money. You want to aspire, say you want to buy a car, you want to buy an iPhone, or you want to go out, say, New Year party to Goa somewhere. Right? So those are goals. So again, as I said, if you don't have any financial goal also, as I said, ensure that you create first an emergency corpus, which is equivalent to 3 or 6 months of your income, right? Then you start investing, say, look at maybe a slightly conservative equity, say like a large cap or a multi flexi cap. So that because this is your first investments, right? You don't jump directly into very high risk investments. So maybe for the first 6 months, 1 year, stay invested in a large cap fund or a multi cap, flexi cap fund. Once you get comfortable with that kind of risk, and you're okay to invest for 5, 7, 10, 15, 20 years, then you can look at more aggressive funds such as a mid cap or a small cap or other ducks. Then that would be a good way to start.
Got it. Now there was so just wanted to give one more before we actually jump into the Q&A. So people like who are still on the call, like thanks for staying on the call for long. We're just giving a promo offer for all you guys. Like if you invest with Simplifin in the next 48 hours, which is 2 days, you will be receiving an additional offer. Like we'll send out the special offer for you guys over email, but just wanted to give you guys a heads up. So with that, like the next question which was coming up from investors was with the budget, there are certain themes that are going to play out. Like if you see the budget, like there is railways, infrastructure, and everything. So is it a good idea, like even being a newbie in terms of investing, is it a good idea to invest in these thematic type of mutual funds?
See, thematic funds are a slightly more concentrated portfolio as compared to diversified equity. So what we normally say is first create your core portfolio. Say, suppose you have 100 rupees, right? Out of that 100 rupees, keep 80 rupees in your core. That is your diversified equity fund, say a large cap, multi flexi, or a mid small. Then 20 rupees, 20% maximum of your portfolio, you can look at thematic funds because it will add a flavor and maybe give a kicker to your returns. Right? Ensure that your thematic portfolio, fund portfolio, does not exceed 20% of your portfolio for the risk management space.
Mhm. Got it. Perfect.
I think
So
there is one
there's
question. Yeah.
yeah. So there's one question. I think you can see that, Ranjan, right?
Yeah. So I receive a lump sum amount. Do I lump sum or SIP? Sir, I would prefer if you do what is called as STP, Systematic Transfer Plan. Right. So what we do in a STP is that I have that lump sum. I keep it in a debt mutual fund, say an ultra short term fund, and then I switch it from an ultra short term fund to an equity fund over a period of time. We normally don't look at lump sums because lump sums is timing the market, right? Instead of that, you can do a systematic transfer plan where you keep your money in a debt fund, and from the debt fund, you start switching over to a equity.
Perfect. So let me just see. There are a couple more questions. I'm just going through the questions actually. Yeah. If there are any more questions, like please feel free to add it in the question section also until I just get the other questions out. Yep. So the other question is if the person is in his 20s or 30s and net income is under 10 LPA, how can he diversify his mutual fund portfolio?
When I talk about diversification, we normally say that if you have 4 or 5 diversified equity funds, right? Say one large cap, maybe one ELSS for tax planning, and maybe 1 or 2 mid and small caps. 4 or 5 funds in the diversified space is good enough for diversification. And along with that, maybe, as I said, up to 20% of your portfolio, you can look at a thematic fund for adding a flavor. So if you have around 7, 8 funds, I think that should be more than enough to create a decent diversified portfolio for a long term on the equity space.
There's one more question. So there are like 5 more questions actually. So the next is like, why do different mutual funds with the same valuation have different NAVs?
Same valuation.
Valuations, I think like the every fund is actually slightly different.
Portfolio.
Yeah.
Okay, he's talking about a portfolio, right? See, you must understand the portfolio that we see is as of the month end, right? So tomorrow is 31st August. So when the portfolio comes out, this portfolio is going to be as of 31st August 2024. 31st, sorry, July. I don't know what the fund manager has done during the month, right? So what he does during the month will get reflected in the NAV. So maybe the month-end portfolio would be very similar, but what they do during the month, I don't know. But that is why funds with similar portfolios might have different NAVs or returns characteristics. And secondly, the NAV is a factor of how old the fund is, right? Suppose it's a fund which has given say 15% CAGR over 30 years. It'll have an NAV of close to 1,000, 2,000. Whereas a fund which has given 15% CAGR over 10 years will have only an NAV of around 100, 150. So that is also the reason why the difference is going to be there.
The next is, how do you see India's stock market growth in the next 5 to 10 years?
We normally say an equity market growth would be my GDP plus inflation. So if I say India grew at 7% per annum plus say 5% GDP, 5% inflation, right? So that would be around 12 to 13% returns per annum. And the best of the corporates will obviously grow slightly more. So if you say the markets grow by around 15% per annum for the next 8-10 years, but this does not mean it'll have a one-way 15% growth, right? There would be certain situations where the markets correct by 8-10%. For a few years, the markets will be flat. Few years, markets will go by 30-40%. But on an average, I think next 10 to 12 years, we could see a 14-15% CAGR growth in the market. That is there.
That's why like the staying invested for long term is what helps you generate wealth rather than just investing a larger amount. So that's why like
Yes.
markets can be flatlined for a couple of years and they could like shoot up in 1 or 2 years itself. But again, nobody can predict which year that's going to be.
Oh, yes. One
The
question
next
has
is,
come.
yeah.
Yeah. How much percent of salary to keep for medical emergency? Any ballpark figure? See, we say emergency was for regular emergency, we say 3 to 6 months. But medical emergencies, see, if you are young and healthy, you'd always say take a health insurance policy. But also, as a part of an investment, right, I suggest you do an SIP for a separate medical fund also. That is essential today because the medical costs are shooting through the roof. Right. So a 6 months of salary, which is as a part of an emergency in debt, can also come up for a medical emergency. But along with that, maybe do an SIP, say in a hybrid fund for, I don't know, from what I see in my family, when I retire at the age of 60, I will need at least a 50 lakh corpus for my medical costs when I retire at the age of 60, right? So target that. So do an SIP in a hybrid fund and target a particular amount where you can look at it for a medical corpus emergency.
The next is the Indian stock market creating a bubble? Are we seeing most of the stock prices as inflated right now?
See, that's what I'm telling. See, markets can be irrational and illogical, right? So maybe if today we feel the markets are very overvalued, imagine in January 2020, when the Sensex first touched 40,000, all of us were talking of that only. Then the markets corrected to 29,000, and from there we have seen a one-way up. Yes, the risk could be there of a market correction. The risk can be that the market does not go anywhere from there, it remains at 80,000, right? I don't know. But my personal view is that what I believe is in the next 5 to 7 years, the markets are definitely going to be much higher than these levels, right? So that's why we say, when you're investing in equities, keep a minimum 3 to 5 year investment horizon, then only enter into equities. If you're investing for 6 months to 1 year, you will be disappointed always.
Yep. And just to add to that, like, so some of you might know, right? There's a indicator called as PE, like the price to earnings ratio, right? Now, when you look at the Nifty 50 PE, which we call as the cumulative market, like right now, the Nifty PE is not like a very high price, even though the Nifty 50 is at all-time high or close to all-time high. The PE is not really at an all-time high. It is somewhere close to its average range. So you can just Google Nifty 50p and you would get that data. So it's somewhere around 23, 24, which has been there, like the 20 to 25 range has been there for the last 5, 10, 15 years at least. So just based on the P,
Yeah,
it
correct.
doesn't look like it's a bubble, at least at the moment. Yeah. Then do you think the current budget will have any impact on India's growth? If yes, what part of the budget should be taken as positive and what should be taken as negative from a long-term perspective?
I think from a long-term perspective, the government's focus has always been on infrastructure development, right? Rural development, railways, roadways, sport. Because once the infrastructure develops, we have seen the areas around the development also progresses, right? So that is the thing. So the progress, the focus on infra development growth is always a long-term positive. But yes, as we have seen, a few things which are not under control would be the taxation aspect. So I think that could be a, I won't say a very much of a negative, but that can be a temporary negative surprise, given that they are so frequently or open to frequently changing taxes. That could be a temporary negative, but in the long run, I think if the government is able to get good revenues and utilize it properly, it would benefit the country overall.
Then the next question that we have is, how should we how should we shortlist the mutual funds? Is it or how do mutual funds actually shortlist stocks? Is it purely fundamental based or purely technical based?
Equities are predominantly, I would say, 95% fundamental base. The technical aspect will come is when they want to buy. Are they buying it at the right price also, right? So that is why maybe a little bit of technical, but it is predominantly fundamental based. Because see, a fund manager, when he buys a stock, he does not buy it with the intention of selling it in 1 month or 2 months, right? They want to create a portfolio which will endure over 5 to 7 or 10 years. And for that kind of portfolio, we need fundamental analysis only.
Hmm. Perfect. So those were all the questions that we had from the previous forms. Uh, we have a couple of minutes, so we can take one more question if there is any from the investors.
Somebody has raised their hand.
Yeah. Let me unmute them. Yeah, sure. Yeah. Harshit, you can go ahead. Harshit, you can go ahead and ask a question. Yeah.
Hello.
Harshit, we are not able to hear you actually. Can you put your question in the Q&A section maybe?
Hello.
Yeah, now we can hear you. Yeah. Uh, I think there's some poor connection. So, Harshit, can you just put in your question in the Q&A section? We'll just take that up.
एक नहीं हेलो
Yeah,
Yes.
yeah, Harshit, now we can hear you. Yeah, I think there's some breakage. Yeah. So Harshit, what we can do is, if you can just share your question, we'll try to answer it offline as well. Yeah. Perfect. So, we have been able to conclude it dot on time. So perfect. Thank you guys. Oh, I think yeah. There's one more question actually that we can take before we sign off. Yeah. So Vinav
Gold
has a question. Yeah. As the gold prices have dropped significantly, is there any possibility that
significantly.
yeah.
See, you must understand why did gold fall? Gold did not fall because the price correction happened. Gold fell because the government reduced the duty from 15% to 6%. And that is why gold prices corrected in India. If you see globally, gold prices have gone up, right? But in India, because the duty was reduced, gold prices came down. And we normally say gold should be around 5 to 10% of an investor's asset portfolio. Right, so if you got 100 rupees, you can keep 5 to 10 rupees in gold. Why? It is a good diversification tool. And as you rightly said, right, gold and stocks go opposite to each other. It's a tool for diversification. So you can have up to 5 or 10% of your portfolio depending upon your comfort zone in gold.
Absolutely, yeah. And there's the addition, like as it goes against opposite the stock market, like it's a good hedge. And when the stock market is down, like at least it keeps your portfolio a bit afloat and gives you the confidence to sort of stay invested for a longer period of time. Perfect. So I think that we can call it as the last question for the day. So thank you all for joining, and thanks Niranjan for having a great session. It was great to actually have you on the webinar. Hopefully our you viewers have been able to understand a lot of ideas around like what investing is, why they should invest, and how to actually go about creating their portfolio as a whole. So thank you for actually taking this session. And for the viewers and for the users who have joined up, we'll be sharing a special promotion just for you guys, which will be shared with you over email. So check out our Simplifin app, and Access Mutual Funds are all available on the app itself. So stay tuned for further promotional offers and further communication for us. And again, like just to end, like this is not going to be a one-all webinar. We will be arranging more webinars based on what topics interest you guys more. So please feel free to share your feedback on what are the next topics that you would like us to arrange a webinar on. Like, is it going to be more advanced, or you want to go more specifically into one category of funds or one asset class? So happy to sort of take your feedback and see what we can do for the next webinar. Perfect. Thank you guys. Have a great
Thank
night.
you.